Welcome back to the channel, traders and aspiring investors. Today, we're diving deep into a fascinating corner of the market, exploring what makes a stock hard to borrow and the potential mechanics behind a short squeeze. We're going to peel back the layers on a specific company that's been popping up on our hard to borrow screeners, NCT, Intercontinental Limited. This isn't just about theory, we're using real, current data to understand what's happening under the hood. So, if you've ever wondered how these high-stakes situations unfold, stick around. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on NCT, officially known as Intercontinental Limited. This company operates in the industrial/marine shipping sector, providing maritime shipping services globally, including time charter and vessel management. Interestingly, they also have a hand in processing pulp, paper, and paperboard products. With a current market cap of just $27.09 million, it's a relatively small player in the global market. Show NCT company logo/info on screen. Looking at recent price action, NCT saw a flat day today, closing at plus 0.0%. Over the last 5 trading days, it's gained a modest plus 0.35%, but if we stretch that out to the last 30 days, the stock is down minus 18.59%. In terms of volume, today saw 470,159 shares traded, which is a bit below its 30-day average volume of 655,048 shares, putting its relative volume at 0.7x average. What is cost to borrow and why it matters? Before we dive deeper into NCT specifics, let's quickly explain one of the most critical metrics for short squeeze potential, cost to borrow, or CTB. When you want to short a stock, you essentially borrow shares from a broker and sell them, hoping to buy them back later at a low price for profit. But borrowing isn't free. You pay a fee expressed as an annualized percentage. The higher this fee, the more expensive it is to hold a short position. When CTB fees start climbing, sometimes even exceeding 100% or even 600% annualized, it signals that demand to borrow that stock is extremely high, and the supply of shares available to short is extremely low. It's like renting a car. If everyone suddenly wants the same limited edition sports car, the rental fee skyrockets. Why this stock is hard to borrow right now. Now, let's apply that to NCT, Intercontinental Limited. What's making it show up on our screen? Well, its current annualized cost to borrow fee is a staggering 677.5%. That's not a typo, 677.5% per year. Highlight CTB number on screen. Even though we've seen some CTB momentum showing a minus 27 percentage point dip over the last 5 trading days, which means the fee has decreased slightly recently, it's still an extraordinarily high rate. This tells us short sellers are paying a premium price to maintain their positions. Why? Because shares are incredibly hard to find. We're seeing only about 25,000 shares currently available to borrow across major brokers. Combine that with an estimated float of a mere 0.3 million shares, there's 300,000 shares, and you have an extremely tight supply situation. Our internal composite squeeze score for NCT, which combines CTB level, CTB momentum, borrow supply, float size, and technicals, currently sits at 42.5 out of 100. This indicates a moderate but notable setup. Squeeze mechanics explained. So, what does it mean when a stock like NCT is this hard to borrow? It sets the stage for what's known as a short squeeze. Imagine short sellers betting that NCT stock will fall. They've borrowed and sold shares. If the price instead starts to rise, perhaps due to positive news or just buying pressure, these short sellers face increasing losses. To cut their losses, or because their brokers demand more collateral, they are forced to cover their short positions, meaning they have to buy back the shares they initially sold. But with only 25,000 shares available to borrow and an incredibly small float of 0.3 million shares for Intercontinental Limited, any significant buying pressure from short covering could quickly exhaust the available supply. This forced buying creates more upward price momentum, which can trigger more short sellers to cover, creating a rapid feedback loop and potentially sending the stock price soaring. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also simply mean that short sellers have very strong conviction that the stock price will eventually fall, and they are willing to pay those exorbitant fees to maintain their short positions. Dilution risk check. One of the biggest buzzwords for a potential short squeeze is dilution. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can easily absorb any buying pressure from short covering, essentially nullifying the squeeze effect even if the cost to borrow is sky high. Think of it as adding water to a concentrated juice. It weakens the flavor. For NCT, Intcon Cayman Limited, our checks show no recent dilutive SEC filings like SMINS1, SMINS3, or 424B found in the last 90 days. This is a positive sign for any potential squeeze thesis, as it suggests the company hasn't recently added a large supply of new shares to the market. Furthermore, we haven't found any recent reverse splits for NCT in our look-back window, which can also sometimes be a precursor to dilutive actions. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For NCT, Intcon Cayman Limited, keeping an eye on a few key metrics will be crucial. Watch for any further reduction in the already scarce 25,000 shares available to borrow. An unexpected surge in price on higher than average volume, especially breaking above its 30-day downtrend, could signal short covering is beginning. Any news specific to Intcon Cayman Limited shipping contracts or financial performance could also be a catalyst. Also keep an eye on that 677.5% CTB. If it starts to climb back up after its recent slight dip, it indicates even more pressure on short sellers. Show NCT chart with volume. So, there you have it, a deep dive into NCT, Intcon Cayman Limited, and the mechanics behind why it's appearing on hard-to-borrow screeners. With an incredibly high 677.5% cost to borrow, a tiny estimated float of 0.3 million shares, and very few shares available to borrow, it certainly presents an interesting case study for understanding short squeeze dynamics. Remember, this is about education and understanding market forces. Always approach these situations with caution and thorough due diligence. If you found this analysis helpful, please hit that like button, subscribe for more unique insights into the market, and let us know in the comments below what other stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next video.